49 cents. That's what a single yes share costs right now on Polymarket. For the contract, Bitcoin below $65,000 in March 2026. 49 cents. Which means the crowd, thousands of traders putting real money behind real predictions, is assigning a 49% probability that Bitcoin drops below 65 grand before the month closes. I pulled this number at 6:14 this morning while my coffee was still too hot to drink, and I stared at it for a solid 30 seconds because of what it implies. Almost half the money in that market believes we're headed lower. Not sideways, not a slow grind up, but meaningfully lower, while Bitcoin is already bleeding below 69,000. And here's the part that should make you sit up straight. The year-end contracts are worse. Some Polymarket books are pricing a 51% chance of Bitcoin trading below 45,000 by December. Others push that probability to 71% for sub 65,000 by year's end. These aren't randos on Twitter drawing crayon lines. These are traders who lose actual dollars if they're wrong. Their shares go to zero. So the question isn't whether prediction markets are interesting. The question is whether they're smarter than you, smarter than me, and smarter than the on-chain data that's telling a very different story. By the time we're done here, you'll know exactly where the crowd is right, where the crowd is dangerously wrong, and what you should actually do with your portfolio before this month ends. Let me set the scene with what's happening right now, because the backdrop matters more than any single contract price. Bitcoin lost 14.94% in February. That's not a dip. That's not a healthy correction. That's the kind of month that turns a $50,000 portfolio into $42,530 and makes you question every financial decision you've made since opening a Coinbase account. The price slipped below 69,000 in late March, and the 66 to 68,000 range became the most probable daily outcome on Polymarket's March 23rd contract. 42% odds for that band, with 68 to 70,000 trailing at 39%. The hourly Bitcoin up or down markets are printing 50 to 51% on the downside during most windows. That's barely directional, but the tilt is there, and it's consistent. Choppy, range-bound, with a gravitational pull toward lower numbers. Meanwhile, the Fear and Greed Index is sitting somewhere between 25 and 30. That's fear territory, not extreme fear, not capitulation, but the kind of uneasy dread where people check their phones too often and hover over the sell button at 2 in the morning. Now, the macro picture is doing Bitcoin absolutely no favors. The ECB held rates steady on March 19th, but JP Morgan, Morgan Stanley, and Barclays all revised their forecasts to expect as many as 3 ECB rate hikes this year, not cuts, hikes, after Christine Lagarde flagged rising inflation risks. The European Central Bank could start raising as early as April, according to SEB's March 20th analysis. Across the Atlantic, the Fed is trapped in its own version of the same dilemma. Elevated real interest rates, sticky shelter inflation under the headline CPI number, and a labor market that refuses to crack cleanly enough to justify easing. Global equity funds saw over $20 billion in outflows in the week ending March 18th, the largest weekly redemption in 3 months. That's not rotation, that's risk reduction across the board. Freight shipping costs have spiked up to 300%. European natural gas prices jumped 25% in a week, and the Strait of Hormuz remains a geopolitical flashpoint, with the Israel-Iran conflict escalating. Oil is rising, stocks are falling, and the bond market is pricing in higher for longer rates across both sides of the Atlantic. Gold, the supposed safe haven, dropped roughly 14% through March, despite an environment that historically should have sent it soaring. Why? Because gold in the short term follows the cost of money, not fear. When real rates climb, holding a non-yielding asset becomes expensive, and even the shiny rock gets sold. If gold can't hold up in a war-driven inflation scare, what does that tell you about Bitcoin's near-term floor? This is the environment prediction markets are pricing. And honestly, when you lay it out like that, 49% odds of sub 65,000 Bitcoin doesn't sound crazy. It sounds almost conservative. But, and this is a big but, prediction markets have a track record, and that track record has a very specific flaw. They're excellent at capturing the current mood. They're mediocre at anticipating inflection points. During the 2022 cycle bottom, short-term prediction contracts were overwhelmingly positioned for further downside right as Bitcoin was carving out its $15,476 low on November 21st. The crowd was right about the pain. The crowd was wrong about the duration. By the time sentiment shifted, the price had already moved 40% off the bottom, and the yes shares on bearish contracts were worthless. So the question becomes, is March 2026 another moment where the crowd is accurately reading short-term weakness? Or is it another moment where fear is peaking right as the structural picture is quietly improving underneath? Let me introduce you to Tomas, a 34-year-old civil engineer who manages stormwater infrastructure projects in Fort Worth, Texas. He makes $78,000 a year, drives a 10-year-old Tacoma with 140,000 miles on it, and spends his Saturday mornings at a breakfast taco spot on Magnolia Avenue, where he reads CoinDesk on his phone between bites of barbacoa. Tomas bought 0.41 Bitcoin at $67,200 on January 8, 2026, using money he'd been saving in a high-yield savings account for about 7 months. His thesis was simple: post-halving supply squeeze, spot ETF inflows, and a Fed that would eventually cut rates. 2 out of 3 of those catalysts have stalled. The Fed hasn't cut. ETF flows have turned mixed, with several weeks of net outflows, as institutions take profit and leveraged ETF investors face mounting drawdown pressure. Tomas is now sitting on an unrealized loss of roughly $800 to $1,200, depending on the day. And he pulled up Polymarket last Tuesday for the first time. He saw the 49% odds of sub 65,000 and felt his stomach drop. Not because the number was shocking, he'd already watched the price slide, but because seeing other people bet real money on further downside made it feel more real than any chart pattern ever could. Tomas is now considering selling his 0.41 Bitcoin to protect what's left and re-entering lower. He hasn't set a re-entry price. He hasn't calculated the tax implications of a short-term capital loss. He's reacting to crowd sentiment the way crowds want you to react: emotionally, quickly, and without a framework. Here's what Tomas doesn't know, and what the prediction market odds don't capture. On-chain data is telling a divergent story. Long-term holder supply, wallets that haven't moved coins in over 155 days, has been steady or increasing through this entire drawdown. Exchange reserves are declining, which means coins are moving to cold storage. People don't move Bitcoin to a ledger if they're planning to sell it next week. Miner capitulation, which was a genuine concern earlier in the post-halving adjustment period, appears mostly complete. Hash rate has stabilized, difficulty adjustments have normalized, and miner revenue per terahash is no longer in free fall. The NUPL, net unrealized profit/loss, is sitting in a zone that has historically corresponded to mid-cycle accumulation, not cycle tops or terminal bear phases. The last time NUPL was at this level while long-term holder supply was simultaneously rising? Late 2023, roughly 4 months before Bitcoin ran from $42,000 to over $73,000. I'm not saying history will repeat. I'm saying the on-chain lie detector is flashing a different signal than the prediction market scoreboard. And then there's the structural argument that prediction markets systematically underweight. Bitcoin's annual inflation rate post-halving is under 1%. Spot ETF assets under management continue to grow on a cumulative basis, even with recent weekly outflows. Corporate treasuries are still adding Bitcoin to balance sheets, not at the frenzied pace of 2024, but steadily, as a long-duration allocation rather than a speculative trade. These are slow-moving forces. They don't show up in hourly Polymarket contracts. They don't shift the 50.8% down odds on a Wednesday afternoon window. But they define the supply-demand equilibrium over quarters and years. And right now, that equilibrium is tighter than the sentiment suggests. Let me flip the lens to Ethereum for a second, because the contrast is revealing. Polymarket's March contracts for Ethereum show 53% probability of ETH finishing above $2,400, with 23% odds of clearing $2,600. That's a meaningfully more optimistic tilt than Bitcoin's setup. Why would traders be relatively constructive on ETH while simultaneously betting against BTC? Part of it is the ETH/BTC ratio dynamics. When Bitcoin dominance gets stretched, capital tends to rotate, and some traders are positioning for that rotation. But part of it is also something more structural. The Nasdaq received SEC approval on March 19th to trade tokenized securities. That's not a crypto-native event. That's traditional finance infrastructure absorbing blockchain technology, and Ethereum's ecosystem. Its smart contract layer, its DeFi rails, its token standards, sits at the center of that absorption. The prediction market is telling you something subtle here. The crowd isn't uniformly bearish on digital assets. It's selectively bearish on Bitcoin's near-term price, while maintaining relative optimism on the broader ecosystem. That distinction matters if you're making portfolio decisions based on headline odds, without reading the fine print. Now, let me walk you through the mechanics of how these prediction markets actually work, because understanding the plumbing changes how you interpret the numbers. On Polymarket, you buy yes or no shares on a specific outcome. If you buy a yes share on Bitcoin below $65,000 in March at 49 cents, you're paying 49 cents for a contract that pays $1 if Bitcoin closes the month below 65,000. If it doesn't, your share is worth $0. The price of that share at any given moment reflects the market's real-time consensus probability. When new information hits, a Fed statement, a whale wallet moving 10,000 Bitcoin to Coinbase, a geopolitical headline, traders buy or sell shares, and the price adjusts. Total volume on Bitcoin prediction markets runs into the millions of dollars, with daily activity in the hundreds of thousands. That's enough liquidity to be meaningful, but not enough to be immune from manipulation or thin order book spikes. A single whale dropping $200,000 into a bearish contract can temporarily shift the odds by several percentage points, and retail traders watching those odds might panic sell their actual Bitcoin holdings in response. The tail wags the dog. The prediction market influences the very outcome it's trying to predict. Consider Priya, a 29-year-old product manager at a healthcare SaaS company in Minneapolis, making $91,000 a year. She collects vintage Polaroid cameras and keeps a spreadsheet of every crypto transaction she's ever made, color-coded by asset. Priya holds 0.87 Ethereum and 0.22 Bitcoin, accumulated through biweekly DCA since August 2024. She doesn't check Polymarket. She checks CryptoQuant and Glassnode. When she saw exchange reserves hitting multi-month lows while the Fear and Greed Index dropped to 27, she didn't sell. She increased her biweekly buy from $150 to $225. Her reasoning? If the people who already own Bitcoin are moving it off exchanges, and the people who don't own Bitcoin are scared, that's a supply squeeze forming in slow motion. Priya's portfolio is down 11.3% from its January peak. She's not happy about it, but she has a framework, A written plan that says increase allocation by 50% when fear and greed drops below 30 and exchange reserves are declining. And she's executing it mechanically. The prediction market says 49% chance of further downside. Priya says, good. I'll buy cheaper coins from people who trust a 49-cent contract more than they trust the blockchain's own data. The tension between these two approaches, Tomas reacting to crowd sentiment, Priya reacting to on-chain structure, is the entire story of this market right now. And it's the story of every mid-cycle correction in Bitcoin's history. The crowd gets the direction right in the short term about 55% of the time. But the crowd gets the magnitude and the duration wrong almost always. In the 2019 correction from $13,800 to $6,400, short-term sentiment was overwhelmingly bearish at the bottom. In the 2020 COVID crash to $3,800, prediction markets didn't even have time to adjust before the V-shaped recovery was underway. In the 2022 grind from $48,000 to $15,400, bearish sentiment was correct for months, until it wasn't, and the reversal caught the majority off guard. So what do you actually do with this information? First, understand what prediction markets are. Real-time sentiment gauges with financial consequences. They're useful. They're not oracles. Second, separate the timeframes. The March contract, 49% odds of sub 65,000, is a short-term bet on a specific price window. The year-end contract, 51 to 71% odds of sub 65,000 or even sub 45,000, is a macro bet on whether the current correction becomes a structural bear market. Those are two very different claims, and they require two very different analytical responses. Third, build your own probability framework. If you believe the on-chain data, declining exchange reserves, stable long-term holder supply, completed minor capitulation, NUPL in the accumulation zone, then you might assign a lower probability to the deep bear scenario than the prediction market does. That gap between your probability and the market's probability is your edge. Fourth, and this is the practical part, set your levels now, before emotion takes over. Open TradingView. Pull up BTC/USD on the weekly. Draw a horizontal line at $64,800, which is the lower bound of the current support zone. Draw another at $58,300, which is the 2025 cycle low retest level. Set alerts on both. If $64,800 breaks on volume, that's your signal to reduce risk by a specific, predetermined percentage. Not to panic sell everything, but to trim 15 to 20% of your position into stablecoins. If $58,300 holds with a long lower wick and a weekly close above $61,000, that's your signal to deploy those stablecoins back in. Write this plan down. Tape it next to your monitor. Because when the price is actually at those levels, your brain will be screaming at you to do the opposite of what the data suggests. The prediction market says there's a coin flips chance Bitcoin goes lower this month. The on-chain data says the foundation is stronger than the sentiment. The macro picture says headwinds are real. ECB hikes, geopolitical chaos, freight costs tripling, gold breaking down despite a war premium. All of these things are true simultaneously. The market doesn't owe you a clean narrative. Your job isn't to pick the one signal that confirms what you already believe. Your job is to weigh them all, assign your own probabilities, size your positions accordingly, and have a written plan for each scenario. The people who do that, the Priyas of the world, aren't smarter than prediction markets. They're just more disciplined than the people who trade based on them. And in a market where 49% of the money is betting against you, Discipline is the only edge that compounds. If this breakdown changed how you think about crowd sentiment versus on-chain reality, hit subscribe. I'll be here next week with updated numbers, updated levels, and the same refusal to tell you what you want to hear instead of what the data actually says. One last thing to sit with tonight. Every single person who sold Bitcoin the last time the Fear and Greed Index was at 27 sold it to someone who's now in profit. The question isn't whether the crowd is scared. The question is whether you're the one selling to them or buying from them.